Hi, I'm Andy. You ever have one of those weeks where you think, surely the AI can't surprise me again, right? Well, this week, it absolutely did. Because the stock it picked? Let's just say, it's not flashy. It's not trendy. And it's definitely not the kind of company that pops up on TikTok next to someone yelling, 10 times gem. But it is one of the most quietly powerful businesses in the FTSE 100. And by the end of this video, you'll see why the AI thinks this one could be a sleeper hit for the medium term. Please be aware I am not a financial advisor, and nothing in this video should be taken as financial or investment advice. Everyone's situation is different, so please do your own due diligence and consult with a certified professional before making decisions. Investing always carries risk, your money is never guaranteed, and you could lose some or all of your investment. So if you're new here, every Friday, after the market closes, I run the same structured AI prompt. It has to pick a UK-listed stock with strong financials, medium-term growth potential, no major red flags, and it can't pick anything it chose in the last 6 to 8 weeks. No cheating, no overrides. No, but I really like this company. Just pure, cold, data-driven logic. And this week, the AI locked onto a company that quietly powers the digital backbone of Europe. This week's pick is Computer Center plc. Ticker CCC. They are one of Europe's biggest IT infrastructure and services providers. Think of them as the people who keep the digital lights on for massive corporations, governments, and organizations that absolutely cannot afford any downtime. Cloud migration, cybersecurity, managed services, hardware, software. They're in the middle of all of it. And they've just been promoted into the FTSE 100. Which is basically the stock market equivalent of being called up to the Premier League. Now, why did the AI pick this one? Well, Computer Center is like that friend who never shouts, never shows off, but somehow always has their life together. They grow steadily. They manage money sensibly. They don't take wild risks. And they benefit from long-term trends like digital transformation, cloud adoption, cybersecurity spending, and companies outsourcing IT to specialists. It's not hype. It's not a moonshot. It's a business that just works. What are the key metrics this week? P/E ratio, around 15 times forward. PEG ratio, about 1.2. Revenue growth, over 7% year-on-year. EPS trend, mid-single-digit growth. Net debt EBITDA, less than 1. Cash conversion, at an astonishing 123%. Free cash flow which is strong and consistent. What do the metrics really mean? APE ratio around 15 and APEG ratio near 1. Tells us the valuation is pretty reasonable for the level of growth they are delivering. Not cheap, not expensive, just balanced. Revenue and EPS growing steadily shows the business isn't just selling more, it's actually turning that into real profit. No wild swings. No drama. Just consistency. Net debt to EBITDA of less than 1. That's the financial equivalent of I sleep fine at night. It means they're not over-leveraged, and they've got room to maneuver if the economy gets wobbly. And that cash conversion rate, over 100%, is a big green flag. It means the profits aren't just numbers on paper, they're backed by real cash coming in the door. Free strong cash flow. Which supports dividends, reinvestment, and the occasional buyback. Basically, this is a company that knows how to handle money. So here's how the AI stitched it all together. Computer Center ticks every box of the challenge. It's financially solid, operationally reliable, and positioned in a sector with long-term tailwinds. Strengths? Predictable earnings. Strong cash generation. Diversified across the UK, Europe, and the US. Risks? Hardware margins can be thin. Corporate IT budgets can tighten in recessions. Currency swings can nudge results around. But overall, the AI sees this as a stable, medium-term compounder. It's not a rocket ship, but a steady engine. And speaking of engines, wait until you see what next week's stock might be. So, how many shares did my £10 buy? At the time of purchase, the share price was £4.25. That means I bought just over 2.34 shares. And right now, at the time of recording, the value of that investment is £9.94. So an unrealized loss of 6p. But really, if you take into account the 5p stamp duty fee charged at the time of purchase, it is about even. Here's the updated AI challenge pie, the breakdown of how the fund is split, and how the challenge is performing so far. Pause now if you want to see the figures. As always, investing carries risk, prices can go up or down. The total value of the challenge is currently £69.19, which means an overall loss of 81p since we started. But remember, this challenge is about the medium term, not quick wins. We're building a story here, one stock at a time. Now, you know the rules. To keep things diversified, the AI won't pick any of the stocks purchased in the last 6 to 8 weeks, so no Rolls-Royce, Auto Trader, London Stock Exchange, Experian, Halma, RELX, or even Computer Center. And now, the moment you've been waiting for. The AI has already chosen the stock for next week. And this one? It's a total gear shift. We've just looked at Computer Center, calm, steady, digital backbone of Europe. Next week, the AI has gone for something with a bit more horsepower. It's a company that literally rents out the machines that build the world, cranes, diggers, lifts, all the heavy kit that keeps construction moving. That company is Ashtead Group, ticker AHT. And we will look further into them next week. If you want to follow this challenge week by week, make sure to like this video and subscribe. Also feel free to leave any comments. I would like to know your thoughts and what you would be interested in seeing in the future. If you want to see any of my other videos, please check out the ones to the right of this video now. The bottom one is the one YouTube thinks you may like to watch next. See you next time.